What makes bonds go down? This is a great question to ask because recently investors have experienced both bonds and stocks going down in unison in their portfolio. That's happened in the past year after having many years of bonds going up when stocks have gone down during those bear market or the times when stock markets are particularly volatile. And that happens because there's a flight to safety. Investors choose to leave stocks and they choose to purchase something that is known as a safe, secure investment. And but there are times when bonds go down. So what makes bonds go down? I'm going to explain really simply in this video what makes bonds go down because it's a really important concept and it's been overlooked and sort of not addressed with the promotion over the past 2 or 3 decades of just owning an asset allocation portfolio where you have a certain percent in stocks and a certain percent in bonds, and it's been overlooked that sometimes bonds do go down in principal or in value as well. So what makes stock bonds go down? All right, so let's say, I'll use an example here, that you purchase some bonds, and we're going to think about not bond funds the way that most investors purchase bonds now. We're going to think about individual bonds, just like individual stocks. These are individual bonds, and you purchase an individual bond issuance, and the interest rate on those bonds is 5%. So you're going to get paid 5% while you own those bonds. I like to think of bonds as sort of like loaning money to someone. And during that time frame, they're going to pay you that 5%, that stated rate on the bond. And again, these are Treasury bonds. They're not subject to things like corporate risk or other types of risk. These are just Treasury bonds that we're looking at. So we're thinking they're safe, 5%. You got it. Okay, so let's say that 6 months go by and you're pretty happy with your 5%. And the interest rates rise to 6%. Okay, so investors are able to purchase new bonds at this point with an interest rate of 6% on them. And you decide that you want to sell your bond with that 5% interest rate because you need the money for something. Okay, so investors in bonds are not going to be willing to pay face value, the full value of that bond, because they can get a new bond with interest rates of 6%. So why would they pay you full value for your bond? That makes the value of your bonds go down. So when interest rates rise, the value of existing bonds with lower interest rates on them go down in value. This is something that you'll want to be aware of as an investor, especially if you have a diversified portfolio in stocks and bonds. And a lot of retirees, certainly in the past, have looked to bonds for income and are looking to bonds once again for income now that interest rates have gotten a little bit higher as of this recording. Where will bonds go? Values go? Where will interest rates go in the near term? I don't know. Nobody can say for sure. We just know that we came off the end of a 40-year decline in interest rates. And while it was a bumpy ride, just like stocks, bonds are a bumpy ride too, because interest rates are a bumpy ride. They're always changing. And even though we had those ups and downs, bonds were in a long-term increase in value because interest rates were in a long-term decrease in value. And now that that's ended and interest rates have started going up again, that's caused the value of bonds that had lower interest rates on them to decrease in value. And that's why so many investors, retirees included, lost value in their portfolios and their bond holdings. That's what I want to share in this video. And remember, retire certain.